Hey guys, Madeline Hewitt here. Today I want to cover the true cost of buying a home. I don't know about y'all, but growing up I heard one thing about home ownership, and that was 20% down. All I knew is that if I wanted to buy a $400,000 house, I would need 80 grand in the bank. Kind of makes home ownership seem impossible as a kid. But so many people own homes, so what's the catch? Today I want to cover the actual cost of buying a house. You've got your down payment, your closing costs, your prepaids, your homeowner's insurance, your appraisal, earnest money. While it may seem like a lot of things, I want to set the record straight on what it actually costs to make home ownership attainable. Disclaimer, I am going to deep dive into all of the variables and costs associated with buying a house, and then at the end I am going to wrap it up in a pretty little bow for you, so don't get overwhelmed, okay? First up on the list, let's debunk this 20% down myth. There is no denying that your down payment is one of the biggest costs associated with buying a house, but I assure you 20% down is not even close to the norm. A home mortgage is a loan from a financial institution, generally a bank or a credit union, and it consists of three parts. You've got your down payment, your interest rate, and your remaining balance or your principal. All right, so your monthly payment has to do with number 2 and 3, your interest rate and your principal. Your down payment is money you put up front to reduce your principal and give you initial equity in the home. There are many different loan programs out there with varying requirements based on income, credit score, eligibility, etc. For example, we have the FHA loan, which is 3.5% down payment, usually used for first-time home buyers, people with lower credit or maybe higher debt. Then we've got conventional loans, which are 3% down for first-time home buyers, and then really any varying percentage after that, 4.5, 5, 10, 15, 16, 20, whatever it may be. These loans are not backed by the government, and they'll have varying requirements based on credit score, income, etc. Then we've got the VA and USDA loans. These are 0% down payment programs, but VA loans are for people who were in the military, and USDA loans are for homes in qualifying rural areas. So why did everyone grow up hearing you need 20% down to buy a house? This is where private mortgage insurance, or PMI, comes into play. So if you use a conventional loan, you will hear about an 80-20 loan to value ratio. If you put down less than 20% on a conventional loan, meaning you are financing more than 80% of the home and have less than 20% equity in the house, then you will be required to pay monthly PMI. This is a monthly payment you make in addition to your mortgage to insure the bank in case you ever default on your loan. So while 20% down is not required on a conventional loan, you will have to qualify, and if you put down less than 20%, you will also incur a monthly fee on top of your mortgage. But PMI does not last for the life of a loan. PMI only lasts while you are financing more than 80% of the home. So once you have over 20% equity in the house, the bank will remove that PMI payment. Okay, so next up we have closing costs and prepaids. Often lumped together, these are not the same thing. Closing costs are all of the fees associated with processing the loan and completing the closing. Prepaids are all of the items you will prepay for the year, such as insurance, interest, and taxes. When you first apply for a mortgage, your lender is required to send you a loan estimate within 3 days of applying. This will estimate all of your closing costs and other loan fees. Now, this is an estimate, but it shouldn't be too far off from the final numbers. Then, 3 days before your closing, your lender will provide you with a loan disclosure form. These are the final numbers due at closing. General rule of thumb for closing costs and prepaids is 2 to 5% of the purchase price as a buyer, but it can really vary so much based on your loan amount, your property taxes, and whether or not you put up, say, discount points. Common closing costs include things such as lender fees, loan origination fees, HOA fees, recording fees, so on and so forth. Closing costs are all of the fees associated with all of the processes and professionals it takes to complete a loan and a closing. Now, on to prepaids. Prepaids include items such as your first year of homeowner's insurance, your interest, and your property taxes for the remainder of the year. All of these will go into an escrow account. Things get a little more complicated and specific towards your deal here, but essentially you will pay 1 year of your homeowner's insurance up front. Then you will pay the interest on your mortgage for the month that you close based on how many days are left in the month. And then you will also pay your portion of the property taxes for the year. So since the seller has already paid the property taxes for the year, you then have to pay for the portion of the year that you are going to be occupying the home. Now, there are 2 ways to reduce or even eliminate closing costs and prepaids upfront as a buyer. Option 1, this is when the seller voluntarily offers seller's contributions to closing. Currently, we are seeing seller contributions come back as sellers are having to really work and negotiate to get their home sold again. But in the frenzy market that we saw in the last 2 years, buyers weren't getting a dime from sellers. They didn't have to. Houses were flying off the market. So your likelihood of receiving seller concessions, the size of them, or being able to negotiate them really depends on the market you are currently in. What happens here is the seller offers money up front to use towards closing costs. You will often see this as seller is offering XXX amount of dollars towards closing costs. That money is then neither added to your loan nor coming out of your pocket. It's kind of like a gift. This may be offered upfront by the seller, or your agent can negotiate as part of the offer. Option 2, say the purchase price of a home is $300,000 and your closing costs are going to run you about $10,000. You can offer the seller $310,000 and request that they give $10,000 back to you at settlement to go towards closing costs. This then essentially wraps your closing costs into your mortgage and keeps you from having to pay those upfront out-of-pocket closing costs. You have to be careful though when you're doing this to make sure that the home appraises for that higher amount that you offer, because your lender will only lend you on the lowest number between the appraisal or the purchase price. Now, one thing to note here is that there are limits to how much a seller can contribute at closing. For an FHA loan, it is 6% of the purchase price. For conventional loans with less than 10% down, it's 3% of the purchase price. For conventional loans with more than 10% down, it's 6% of the purchase price. So as long as the contributions do not exceed these limits, they can be used towards covering all or part of your closing costs and prepaids. Okay, so you found a house you love and you've made an offer. What are the other costs that you're looking at? Well, first, you will have a home inspection. This isn't a requirement, but it is highly, highly recommended. This is where a licensed inspector will come through and do a thorough walkthrough of the house, making sure there are no structural problems, checking your attic, your crawl space, systems, appliances. They will also make note of any repairs that need to be done. Not only does this give you peace of mind that you're buying a sound house, but it also gives you the ability to negotiate repair costs with the seller. You can either ask that the seller complete the repairs on their own, or you can ask for a seller credit towards repairs at closing. Now, you may have other inspections you want done based on the property that you're buying. For example, if the home is on a septic tank, you may want to get a septic inspection. If the home uses well water, you may want to get a water quality test. If it has a chimney, you may want to get chimney inspection, so on and so forth. And now, this could get a little pricey, but trust me, the upfront cost of paying for inspections does not even compare to the back-end cost of buying a house with problems you knew nothing about, and you don't get the chance to ask for the money from the seller to fix it. All right, so you have the house you love, you got the inspection done. Next up, your lender will order an appraisal. Appraisals are done by a lender to make sure that the house is actually worth what you are paying for it. You will only be able to borrow up to what the home appraises for, or the purchase price, whichever number is lower. So say you're in a hot market, right? And the purchase price on a home is $500,000, but it only appraises for $480,000. The bank will only loan you up to $480,000. Some lenders will have you pay your appraisal up front, others will have you pay it at closing. But the average cost for an appraisal is somewhere around $500. Now, when you go to make an offer on a house, you more likely than not will put up an earnest money deposit. This is a good faith deposit, ensuring the seller that you are serious about making the offer. You will say how much your money you want to put up in the offer, but you're not actually required to pay it until the offer is accepted. This money is then held in an escrow account. This will be used towards the cash close, all right? So while it is an upfront cost, it does come back to you at closing. It is used to let the seller know you are serious and don't intend to back out of the deal. If you do back out, in most cases, you will lose this money. All of the details regarding your earnest money deposit are in the contract, so please be extra sure that you are clear with your realtor on all of the caveats about when you will and won't lose this money. Typically, earnest money deposits are somewhere about 1 to 2% of the purchase price, but there is no standard. Okay, next up, we have any interest rate buy downs you participate in with your lender to reduce your interest rate. Those will also be due at closing. You pay these in discount points, which are 1% or some fraction of the loan amount. I go into further detail on interest rate buy downs at the video linked below. Okay, I may have just made it seem like home buying was more expensive than that 20% down figure, right? Fear not, let me simplify all of this down for you, okay? So your down payment is typically 3 to 20% of the purchase price. Your closing costs and prepaids are typically 2 to 5% of the purchase price. If you live in an area that you know has high property taxes, I would err on the higher side. And if you live in an area that you know has lower taxes, you can be a little more conservative. You've got your home inspection, $500. You've got your appraisal, $500 to $600. Your just-in-case funds, fees, and earnest money, they're going to run you about 1 to 2% of the purchase price. All right, so let's do a little hypothetical. I like to err on the side of caution when budgeting, so I'm going to pretend we aren't getting any seller contributions here as they're never guaranteed. All right, so say you are a first-time home buyer purchasing a $400,000 house with a 3% conventional loan. Your down payment is going to be about $12,000. Your closing costs and prepaids, we'll use 3%, so $12,000. Home inspection, $500. Appraisal, $600. Earnest money, $4,000. All of my upfront costs will run me about $29,100, with that $4,000 in earnest money coming back to me at closing. So essentially $25,100. Now, when do you actually start paying all of this money? Looking for a house, free. Fun fact, real estate agents are essentially free to a buyer, as the seller typically always pays agent commissions at closing. Pre-approval from a lender, free. Making an offer, free. Offer accepted, ching, ching, ching. This is where you will actually begin paying money as a buyer. You will have your earnest money deposit, your home inspection, your appraisal. Now we are at closing. This is called cash to close. This is where you will pay your down payment, points if applicable, closing costs, and prepaids. So let's go back to our hypothetical. Say you are buying a $400,000 house with 3% down payment of $12,000, and you put up $4,000 in earnest money with $12,000 in closing costs and prepaids. Your cash to close would be $12,000 plus $12,000 minus $4,000, $20,000. So with no other seller concessions at closing, this is where you will write that big fat check to the title company, shed a little tear, receive your keys, shed an even bigger tear because you have officially closed on your home. Important note here, this is just an estimate of your home buying saving needs. I highly recommend having an emergency savings fund when you buy a home comprising of a couple months of reserves. This prevents you from spending every single penny you have buying a house, and then you're back to $0 in your account after that. This results in a pretty stressful closing period and first few months of home ownership. The home buying process is fun. It's exciting to think about the next chapter. But let me go ahead and tell you, life comes at you fast once you find what you like. You have a lot of hands in the cookie jar, moving and shaking to make this deal push through as quickly and efficiently as possible. So please don't rush the financial prep phase. really understand the costs associated with homes in your budget and in your desired area. Thank you for joining me today. As always, I hope that you found this video helpful and informative. If you did, please don't hesitate to give this video a like and go ahead and subscribe to my channel so you stay up to date on all of my latest tips, tricks, and education in the world of real estate. I hope to see you guys back next week.